All right. Welcome back to the Weekly Rebalance. It's Halloween week, almost the end of October. I can't actually believe it's November next week.
I know. End of the year coming almost
Gone
quick.
by really, really quickly. But it's a busy week. I know a busy week for lots of reasons. One of them being the Fed and what's going on there. It's going to be an interesting week there. For me at least, Nick, I don't think very unlikely that there's some type of surprise. I think we're very likely to just get a 25 basis point rate cut, but it's going to be interesting to see the commentary coming out of there, probably more than anything else, which is, oftentimes the case. But what are you thinking? What are you seeing there?
Oh yeah, I absolutely agree. I think that's been the case for a lot of the previous meetings in recent years. We've typically known what was going to happen, at least had a good idea of what was going to happen, but the commentary has always been what either caused a large market movement, not necessarily the announcement, um, and really what provided the interesting data from the call.
Yeah,
I don't think we've had a huge surprise in a good little bit.
yeah, in some time. Well, I mean, it looks like so they're going to cut 25 basis points, or at least that's what everybody thinks. It's obviously, it's a little bit tricky at the moment because they're dealing with some lack of data with the government shutdown, but obviously the big concern is the jobs market and employment. I am really, I saw some interesting stats this week. One of them was that some of the unemployment numbers were that are coming out, the government shutdown is actually affecting the unemployment, right? Which is
Yeah,
some of that's going to be the back pay for government workers and whatnot once the government reopens can be reinstated, but a lot of that's actually going to be lost because you have, for every one government worker, there's two contractors. And a lot of those contractors are not going to be receiving their backed pay. They just didn't work during that time. So it's going to be interesting to see. I think it even gives the Fed more ammunition to lower rates again. And now, I mean, a lot of the projections are saying, two more cuts this year and then four total over the next 12 months. I think it's very possible. It's hard to say, obviously, but I think that's a really possible thing at this point.
definitely. Absolutely.
Yeah.
I
So
just took a look at the sorry, I didn't mean to cut you off. I just took a look at the CME Fed Watch tool, and Fed fund futures are pricing in a 99.9% chance of a 25 basis point cut tomorrow.
yeah,
So
99.9%. So yeah,
pretty
that's happening most
pretty
likely.
definitive from the interest rate market there.
Yeah, exactly. Well, we're obviously we're getting a steeper yield curve, which I think is, uh, you know, what everyone expected here. You were telling me some interesting stats earlier about what happens in different yield curve environments,
Yeah,
specifically yield curve environments where the yield curve gets steeper.
yeah.
Because there's different types of that. We'll see. Some of it's been contrary to what history has given us the last, uh, you know, year or so as this has unfolded.
Yeah, absolutely. It is an interesting subject, and I've got some charts here prepared to go through specifically on that subject. But yeah, specifically, curve steepening just being an interesting subject because you can really have it come from two sides of the curve. You can either have it from the long end of the curve going up, or you can have it from the short end of the curve going down.
Hmm.
So you call when you have the short end of the curve going down because yields are going down and prices of certain bonds are going up at least, you would call that bullish steepening. And if you have the long end of the curve going up, causing that steepness in the yield curve, you would call that bearish steepening because the prices of certain bonds are going down. So that's kind of the two possibilities that you have that would make a yield curve steeper create different environments, because where that curve is moving speaks to what bond traders expect from the future, how they see current political, geopolitical developments, that sort of thing. And if it's coming from the short end of the curve, obviously that's more related to the Fed, that sort of thing. So you end up with two very different markets, and other parts of the markets react differently. So yeah, you get some interesting dynamics at play there. So when we're talking about the curve steepening, there's a couple possibilities, and depending on what actually happens, you can get different results. Now, I think the interesting thing, and I think we've talked about this a little bit, but I think the interesting thing is with this, and I guess there's always a component of both. Maybe whenever you have a move in the curve, you potentially have little bits of both. But specifically in this environment, I think we'll see a decent amount of movement on both ends of the curve. Don't
Yeah,
you? Like we'll see
I
short
agree.
rates coming down and potentially at some point see long-term bond rates going up.
Yeah, I mean, we have, yeah, I think you're right. So, especially because, if you think about the Fed is trying to balance employment with growth and keep inflation under control, right? And employment's a concern right now, so they're lowering interest rates. They're lowering yields on the short end. Uh, Growth has actually been okay. GDP growth, that's
Yeah.
another data point we're getting soon as well. It's been good. It's been driven by the consumer and been okay. And then you have the risk to the lower interest rate environment, which is inflation. If you get inflation higher than expected inflation, which we still are, that's something that we, you don't want to overlook, but we're not at the 2% target for inflation. We're above that. And if that continues, and especially if it rises, I think the longer term yields likely rise.
Yeah, absolutely. So you've definitely got that at play, just the inflation relationship going on, but also specifically in the US market, and while we're talking about the yield curve, we're really talking about the US market, but also just the policies that are coming from the Trump administration are signaling that we'll probably be running a little bit more of a deficit than potentially in years past. So adding additional stress to the credit market, specifically on the long end of the curve, um, as well, which could cause some movement at the far end of the curve as new policies and everything like that are enacted. So another interesting thing to note as well, just coming from fixed income markets. But
Yeah.
specifically, I think we'll start by just taking a look at the short end of the curve. And just so everyone knows here, we've got this great article here from Macro Bond. It was written by Carl Nilsson, who I believe is one of their product specialists. But he wrote this really interesting article, and they have really great data over there at Macro Bond that provides some nice graphical insights into current economic data. So thought we would bring in some of those here. But specifically, he was kind of talking about the two different types of environments that you can have where a yield curve is steepening, so bullish and bearish steepening, and kind of where we're at right now and what we can expect to see given one or the other, or potentially both. So this first chart here I thought was interesting, and it highlights basically the difference in what the Fed dot plot suggests, the median dot plot suggests in terms of the path for interest rates. That's short-term interest rates going forward. So these dots here are the median dot plot coming from the Fed governors. And then this red line here, this is basically what's expected or implied by Fed funds futures, the prices of Fed funds futures. So how traders are kind of reacting to this data, what they sort of expect. And I think the big thing to highlight here is just the difference between the median dot plot of the Fed governors and this Fed funds futures expectations. Because you can see here that the Fed funds futures expectations really kind of suggest that we're going to get down to that 3% mark, or they're going to get this rate down faster than these dot plots suggest. So that's just a little bit of a disparity going on. I mean, it's interesting. Obviously, all of the different Fed governors, they have different opinions on what's going to happen. Specifically, Moran is an interesting one. He's a newly appointed Fed governor, and he's particularly on the low side. He's expecting lower rates for the Fed funds rate. So um, definitely, there are some governors that are a little bit more aggressive, that sort of thing. But this kind of disparity, just seeing this play out, and it's really nicely represented here in this chart. But interesting thing to note, and your expectations for how the yield curve is going to move at any point in the curve really inform your decision as a bond portfolio manager.
Yeah. So that would indicate that we're likely in for a surprise cut at some point, or a bigger cut than expected at some point in the next year.
Yes, so, that's at least what some of the market is saying, and I guess potentially some of the Fed governors too, because like if you take a look at this here, I believe this red line here, this is more of the median expectation. But you've got other Fed governors who are on the lower side, specifically Moran. And I don't actually think that they know for certain that it's Moran's dot plot, because I don't think they like label who's who, but it's
Just
just
assuming.
all of the sudden we had this lower line on the dot plot, and everyone was like, oh, okay, we know who that is. So I don't think it's unreasonable to assume that it's him, especially given his commentary that he's had out there, specifically
Right.
on his idea of a lower neutral rate, that sort of thing. I don't think it's ridiculous to assume that if we don't know it for sure. But um, yeah, so definitely there is an expectation for a little bit more aggressive cutting than maybe the median dot plot suggests. That's for sure.
Yeah. So what sectors do well when you have when the short end of the yield curve is falling faster than the long end?
Yeah, and I think that was the most interesting part of this article here, and kind of why I wanted to share some of this data today. They had this really neat article where basically they had bull steepening regimes and bear steepening regimes since 1990, and then the returns of assets within those regimes. And some of these relationships are more of what you would expect, like real estate and a bull steepening, because the long end of the curve is not going up so much. It's doing well. Credit
Right.
is easing. Lower short-term rates suggest money's a little bit easier to come by, that sort of thing. So real estate tends to do well when you have bull steepening, but not when you have bear steepening, because mortgage rates are going up with that tie to the long end of the curve.
Right.
Um, I
Real
think,
estate actually loses the ground in a bear steepening. It looks like there's actually a negative return.
yep, exactly. Just it's getting more expensive to buy a house in terms of your borrowing costs. So
So is the
uh,
S&P 500 real estate, is that what's inside of the S&P 500 real estate? Are we talking mainly home builders? Uh, what do you know anything else that's in there?
yeah, I think home builders. There's probably some like supply companies, that sort of thing, but just and then most likely realtor company,
Yeah.
listing agencies, that sort of thing.
Data center REITs, towers like American Tower and
Yeah,
stuff like that. Okay.
it is kind of a broad, like,
Yeah.
it's not just residential housing.
Yeah, I was doing some research on that recently because I think we talked about this even last week. Some of the interesting investment opportunities in the AI space are in real estate, specifically in data centers. So, but if you look at just buying a real estate ETF, you're not getting pure. There's a lot in there. There's home builders. There's towers, there's data centers, there's a lot of stuff in there that isn't necessarily
Yeah.
like you said, just related to the residential housing market.
Oh yeah, yeah, absolutely. And I think it's interesting. I think it's definitely of the ones that are brought in here. I'd imagine, aside from the bonds, the bond returns, which are obviously going to be related to this. Um, just probably the most direct relationship in terms of
Right.
price movement. So kind of seeing
Perfect correlation. Bull steepening, positive real estate return, right?
Exactly,
negative on
exactly,
the bear steepening.
exactly. Yeah, and I mean, you see the same thing play out with the treasuries that they have in here, corporate bonds. It moves in the same direction, kind of like you'd expect. So
Right.
some interesting stuff there. I think, one of the things that kind of took me by surprise was in bull steepening uh, markets or regimes, IT and communication services have over the past, 35 years have performed negatively in bull steepening in environments, which right now, you have movements both on the long end and both and on the short end of the curve. But predominantly at this point, we've seen the long end of the curve come down at least a bit, and we're seeing the short end of the curve come down a good bit as well. So, you know, in a bull steepening kind of regime right now, I would say, or at least going into one, and we've seen those two sectors perform very well.
Right. Yeah.
Continuing to
Opposite.
perform very well. So I found that one interesting, and just like borrowing costs, cheaper money, it just tends to be good for growth companies. I mean, it tends to be a catalyst for a lot of different types of companies, but tends to be good for growth companies, especially if they're borrowing money on a short-term basis. Also, just for the consumer as well, they can get more access to cheaper money on the short end of the curve to finance, appliance purchases, that sort of thing. Just
Right.
tends to be good for that sort of thing. So I was surprised by that, those two in
It's,
specific.
yeah, that surprises me too. It's interesting. Hmm. Well, I guess we'll see
Yeah.
what happens there. Yeah, I think that it's going to be like you said, what unfolds in the yield curve is going to be really interesting. Our rate, everyone thinks a lot of people think that short-term rates are coming down, and that's great, right? It's going to make housing costs cheaper, right? Well, hopefully
Yeah.
that's the case, right? But that we have our risk out here, which is that we have increased inflation, right? Which actually is going to likely push, that's very highly correlated to pushing up longer term yields.
Hmm.
I don't know. It's interesting. It's going to be very interesting to follow. What you see in these periods is, and I wanted to talk through this, myself a little bit,
Yeah.
going through, you know, okay, so we're fighting employment issues. We're trying to keep growth up. The consumer is a huge part of growth, especially GDP growth. I mean, do you happen do you happen to know the amount of GDP that personal consumption makes up of GDP? It's the biggest part, but just out of
It,
curiosity, do you happen to know what it is?
yeah, it's a good amount. I know that, and you actually we were talking about that a little bit earlier today. I don't know if we went over specific numbers, but 60%.
That's really close. Yeah, it's grown significant. Here, let me share my screen now. The It's grown significantly. It's now 68.2%.
Wow.
And that has grown notably from previous decades. So, the consumer, the consumption in the 50s, between 1950 and 1970, that was about 58 to 60%, 62% of GDP. In the 80s and 90s, 62 to 65%. In the 2000s to 2010, 65 to 68%. And now, the 2020s, it's hovered between 67 and 70%. So obviously, now some of that makes sense, right? We're switching
Yeah.
to a services economy, right? uh, Healthcare, education, financial services, all of that is a consumption-based economy, a services-based economy, and that so the spending there is what's driving that. Makes makes some sense, right?
Yeah.
But I think the other thing that was really interesting to me is okay, so getting back to the inflation topic, right? Who is driving consumption, right? Because
Yeah.
do you not, like you don't need to be, you don't even need to have the data in front of you to look at this, but do we not know that a lot of the middle class and the lower income earners are struggling with the higher inflated prices that we're dealing. Even though inflation's come down, that's the thing everybody forgets about. Inflation has come down, right? We're not, where we need to be or we're supposed to be yet, according to the Fed. But it's not like those prices all of a sudden, the price of whatever has, it's not like the producer of whatever good you're talking about has then, oh great, we adjusted our prices down. It just is not going up as fast anymore. So things are still very expensive for people. I mean, the cost of food, the cost of real estate, the cost of everything is, I mean, you know what I mean? It's people are struggling, especially the lower income earners in the middle class are, it's shrinking and they're struggling with those costs. So it's difficult to, anyways, that's the big risk that I feel like we're going to experience here as we have lower and lower interest rates. Money is cheaper and cheaper. And what usually happens during those periods is we have an expansion of the wealth gap, right?
Yep.
So that's where I feel like it's great. I think it's good that interest rates are coming down for the middle class, for the lower income earners. It makes money cheaper, but it's this perpetuating cycle where oftentimes the end result is a wider wealth gap. You know what I mean?
Yeah, absolutely. And I mean, that ties into what we're seeing on long end of the curve moves, just in terms of reaction to inflation. People who hold real assets, own a home, own stock market assets, assets in the stock market that tend to do well in inflationary periods.
Right.
They tend to benefit a little bit from inflation, whereas, maybe someone who doesn't have access to that doesn't. So
Yeah.
it's definitely tough.
Yeah, exactly. So we've seen a consistent decline in the middle class. I think the most interesting thing for me was this little graph, which was just showing the percentage of income share by tier. The upper income earners, the middle income, and lower income. Lower income earners have stayed fairly stable through slight increase, a slight decline, but overall pretty stable. But the upper income, it's being concentrated higher, more and more. The income share is being earned by the upper income, and the middle class, the middle income has continued to drop off over the decades, and the amount of wealth that is maintained by those earners is extreme as well. This again, if you think about it, it makes sense though. So you have if you think about a person who has very little invested or no invested, and someone who does, and you go through these cycles, everything gets more expensive, but you have an inflation hedge if you're invested in assets that give you an inflation hedge, right? So that could be real estate, that could be gold, that could be stocks and bonds. Although I would say I would caveat that bonds don't typically offer a very good inflation hedge, but at least they have some growth compared to just cash or nothing. But yeah, it's very, it's an interesting conundrum because that inflation really is, that inflation is particularly dangerous to the middle class and the lower income earners.
Yeah, absolutely.
So
Absolutely.
we'll see what happens there, but you can see it contracting significantly, and that's definitely a large risk if we continue to see inflation. And again, it's been more under control recently than it was in 2022, but it's you know definitely still out there. We're still above target, and we'll see what happens. I do think if we do see a spike in inflation, it's very different than 2022, though. 2022 was a global inflation story. I think if we do see a spike in inflation, a lot of that is coming from, you know, coming from issues in the US, right? So it's more of a US story. A lot of the inflation being caused by tariffs at the moment. Lowering of interest rates can add to that as well. But I don't necessarily think we're in for a global inflation story like we were in 2022, but which is a good thing, but could continue to be an issue here in the US for some time.
Oh yeah, absolutely. I'm really interested to watch and see how tariffs end up playing out on, corporate balance sheets, but just also in terms of inflation to products. I know, the typical conventional wisdom is that tariffs end up in a one-time price hike and basically after that, stabilize and don't necessarily contribute to ongoing inflation as we would typically call it. And I mean, all of that makes sense. You add on an additional expense and it gets absorbed, and that's the end of it. But I'm really interested to see how that actually ends up playing out, just given how much we import right now. Wage price spiral being a thing that's been discussed in the past. Um, I think it becomes a little bit more complex than just that conventional knowledge that tariffs end up in a one-time kind of inflation spike. So I think that's going to be a really interesting one to watch.
Yeah, yeah, for sure. I mean, we've started to see some of this in the operating margins and their operating margin forecasts that,
Yeah,
and earnings, it's kind of funny. A lot of earnings have beaten the
yeah,
expectations, but they're coming from already revised down expectations after
yeah,
the tariffs. Well, anyways, that's great that they're beating, but it's coming from a point of already lowered revision or lowered expectation. So we'll see. But yeah, I mean, even the if I was looking at if you look at like the S&P as a whole in their operating margins, the forecasts have come down about a full percentage point from the beginning of the year for where operating margins would be. Um, then most of that is a lot of that is due to the tariff concerns, which again are inflationary. So there are multiple inflationary metrics here, or contributors here in 2025 and into 2026 as well.
yeah, absolutely. Absolutely. And I mean, we continue to see changes in the tariff policy. So who knows where we actually end up in terms of what actually ends up getting applied. I feel like we're always talking about in Q2, we were talking about Q3, we'll really see the impacts. And now I'm like, yeah, maybe
Yeah.
it's Q4, maybe it's actually Q1. We'll see.
Yeah. Eventually, eventually it will display itself, but yeah, definitely it's a lot of, and a lot of the issues have been kind of, overshadowed by there's just phenomenal growth in those Mag 7 names, those Magnificent Seven names that just continue to just, you know, be fine in all environments. It seems
Yeah.
like. But like we've talked about many times, that doesn't necessarily just last forever, right? So good, just always a good reminder to think through that clearly.
Yeah, absolutely. Absolutely.
Yeah. So, anyways, well, that's a lot of what I had on my mind for this week. Anything else you're thinking of, Nick, for this week? It's Halloween.
Yeah, I
That
know it's Halloween. I tried to come up with some sort of an interesting story on candy manufacturers or companies that are related to the candy manufacturing industry, just to tie it all up to the Halloween week. And not really like a compelling story across all of the candy manufacturers that I could think of, taking a look at their underlying performance, things like that. Couldn't really find like a cohesive story that would make for interesting podcast content, but just
yeah.
just interesting. I think the most interesting thing to me that was a little bit surprising to me was of Hershey's, Mondelez, and Tootsie Roll. Tootsie Roll has been the best performer year to date, which I
There you go.
wouldn't have expected it, knowing that Tootsie Roll is, I'm pretty confident, the smallest of the three. Uh,
Yeah.
they're up 13.58% year to date.
Very
So
nice.
Not necessarily. They're getting close to the S&P 500, but
Yeah.
um, I would not have expected that. That was really the most interesting thing I could find in terms of candy manufacturers without going too deep on it. But
Yeah. Not a very large sector of the market, but this is their week. This is their week.
this
Go
is
buy
their
you.
week.
Well,
This is
now
the
through Christmas, right?
Yeah, yeah. This is their time. I think, that was kind of the funny thing. I was just looking around and seeing if there was any sort of interesting research that people have done along the lines of candy manufacturers around Halloween, if there's some sort of unexpected trend that we would see. And I think most of the articles said that we see candy sales pick up around this time of year. And that
Yeah.
that's that's about right.
Makes sense. Makes sense.
That makes sense to me.
Well, go out and support Tootsie Roll. Maybe they can keep their performance going up.
Yeah, let's see here. Maybe instead of going down that road and specifically looking at the finances of the industry, since we don't have anything too particular, do you have a favorite candy?
Yeah, my favorite candy is actually a it's Smarties, but not the American Smarties that you're thinking of. The Smarties, they're I always went to Canada growing up as a kid, and I love their Smarties. Those are my favorite.
Yeah, I think you when I was in the office one time, I think you had some. I tried them. They were good.
Yeah. Do you have a
They were,
favorite one?
I go back and forth. I really like sweet tarts
Oh, those are good. Yeah.
for what, yeah, I really like sweet tarts. I like chocolate, obviously, but
Yeah.
I don't know. I feel like I gotta go sweet tarts, which I think are kind of like those Canadian Smarties.
Yeah,
They're
they
kind of like them.
might be, yeah, they might be a little bit more like them. Yeah, the Canadian Smarties have more, like if you compare them to M&Ms, they have more of a thicker sugary coating on the outside and a little bit of chocolate on the inside, comparatively speaking. But I always like those. I don't quote me on this, but I believe they were developed for soldiers to carry into battle as like little sources of
Oh,
energy, sugary sources of energy, and the candy coating was thicker on the outside so that they wouldn't melt the chocolate,
oh, okay.
like when
Yeah,
it's in their pocket. So
that makes sense.
yeah,
That seems like yeah, that's a Canadian product. Take some
yeah,
candy.
Canadian.
Yeah, I like it. I think the Germans gave their soldiers meth at a period of time.
pretty
There's some like
pretty sure they
interesting
did.
stores. There's like some interesting stories out there. So I don't know why the Smarties made me think of that, but you're sitting
So,
there talking about that, a boost of energy. I was like, oh yeah, I'm pretty sure they gave their soldiers meth.
yeah, I think they did.
So candy is probably healthier.
Yeah, probably. Most would say that.
I suppose that the interesting, economic stock market, just finance side of the candy industry, now that I'm thinking about it, we're sitting here talking about, we could have talked about was, you know, going back to real sugar,
Oh
cane
yeah,
sugar. I didn't think of that until now, so that was a
yeah.
missed opportunity.
We'll have to keep that for like I don't know, what's another big candy holiday? Valentine's Day?
Yeah, Valentine's Day.
It's a
We
good
could
one.
do. Yeah, I might have to save that one for that.
Yeah, save that for Valentine's Day.
Yeah,
All right. Cool. Well, if you don't have anything else, that I think wraps us up for the week.
think
We'll be
so.
back. We'll be back next week, back on next Tuesday, and we'll officially be in November then.
I know.
Yep.
Flying by.
All right. Bye everybody. Thanks, Nick.